Things have been really interesting with the consumer lately, and I'm really excited to break that down, talk about consumer staples, consumer discretionary, that whole sector, that dynamics going on. And I think this is going to be exciting for our listeners too, because we're going to do a series of podcasts breaking down the individual sectors, our outlook right now, what we're looking for in 2025, and the dynamics that we're paying attention to.
Yeah, exactly. I'm really excited to, get into a series where we, take one piece at a time and really dive into that. So today, something we're looking at is consumer spending over the cycle, because it's really shifted in a lot of different directions, where consumers feeling a little bit more pinched. And so they're still spending up on some items and moving down in quality and price in other items. So I'm really excited to get into that.
Yeah, absolutely. And I think it's important to note, as a disclaimer, that we do own positions in some of the companies we're talking about today, namely Walmart. We're going to talk about a lot of consumer companies, but just make that clear as we dive into this podcast. We do have vested interest in some of those, but we're talking about them because we are excited about them at Beck Capital Management.
Exactly. We wouldn't really be doing our jobs if we didn't hold positions where we were bullish. So,
exactly. And so really setting the stage for why we're talking about the consumer, what's been going on. It's been really interesting seeing the consumer staples and consumer discretionary, particularly the discretionary sector, as far as performance has gone so far this year.
Yeah. No, to your point, XLY, the consumer discretionary ETF, that sector is being primarily driven by Amazon and Tesla this cycle. Excluding Amazon, it's up about 15% this year. Excluding Amazon and Tesla, it's closer to 9%. And that's relative to the S&P, which is over 26, probably closer to 27 at this point.
Right. I think that's an interesting dynamic. And as we dive into this, it's really interesting to see, even within that portion of the consumer discretionary market that's not Tesla and Amazon, because those are very unique circumstances. If you think what people are spending their discretionary dollars on, well, Tesla is more of a tech company. Amazon with AWS has become more of a tech company. Of course, they've got their retail marketplace, but excluding those, I mean, you've got really big divergence in performance. And getting to the why, it's because as interest rates have inclined, the Fed's tried to cool the market. Consumers have really felt the pinch, with the majority of that coming from huge inflation gains in everyday goods that they're buying. So whenever your everyday groceries, your consumables, things that you have to spend your money on, when those increase and take up more and more of your budget, you only have so many dollars to spend on the fun things, the discretionary items that you want to buy. And so between the inflation, you do have wage gains with considerable increases, but they haven't kept pace with inflation over the last few years. And so those wages are still catching up, which is leaving consumers very tight in their spending on a go-forward basis. Now, I think one of the positives, kind of a silver lining, is that we've seen retail sales growth in general, but it's really only kept pace with what should be normal inflation, somewhere around 2-3%. It's really trickled down from what we saw in 2020, 2021, when you had pretty massive consumer spending. I mean, part of that was COVID with people staying at home. But it's created an interesting dynamic where retail sales growth just really hasn't kept pace with inflation over the last couple of years.
Yeah. And then on that, people aren't buying as many cars, as many houses, now that, like you mentioned, interest rates are higher. Those things that you traditionally finance, namely autos and homes, aren't being purchased in the same quantities as before. So those dollars are still finding their way into the economy on some scale. But, I think it'd be really interesting to take a look at the lower end consumer, kind of your mid to high end consumer, and then your true like luxury, highly wealthy consumer, and just kind of take it piece by piece, because we are seeing an interesting like dichotomy, almost what I've kind of started calling a trichotomy in this in the consumer discretionary space. So Victor, if you'll lead us into that.
Yeah, I think that's a great way to break it down. So starting with your lower end consumer, one who's spending the majority of their dollars on those consumer staples, on the things that they have to buy, groceries, items to sustain their lifestyle. they're really shifting. I mean, well, I should say they're not really shifting all that much. If you think about the, conscious consumer, it's a lot of Walmart spending, for example. So Walmart's your cheap retailer. Those individuals who have been going to Walmart are continuing there because no other store is really giving them better value. And when you talk about other stores that brand themselves as cheap or cost conscious, the dollar stores have really fallen out of that category. They've had supply chain issues. They don't have the size that someone like a Walmart has, so they don't have the same economies of scale. And the quality of those stores has really gone down. Grocery spending has become a larger portion of the consumer budget, and those dollar stores don't really offer as many grocery items. So you've seen Dollar Tree, Dollar General, Five Below, all of those companies are down 40 or more percent year to date, while you've had companies like Walmart rally pretty significantly, beating the S&P on a year to date basis.
And to that point, stores like Target have seen a big shift kind of away from them down into namely Walmart, because, it's the kind of classic joke of you walk into Target for, a box of cereal or a pint of milk, and you walk out with a cartload of house stuff that you don't really need. And there's not so much appetite for people to do that nowadays, because they do realize, as fun as that can be, it doesn't really fit with their, financial goals and, what they're really able to spend right now. So they go ahead and just make that Walmart trip, forego the niceties of what Target's traditionally had, whereas a bunch of nice stuff that you may not be directly shopping for, but things that they can sell on the side, which are traditionally really high margin items. I think that's something that's been really big between the Target and Walmart competition directly, is that Walmart operates a lower margin business. Same thing between the two stores. Likely Target's gonna be higher priced, so people are moving down into Walmart to get those items.
Yeah, definitely. And I think a huge part of this is the online presence that Walmart has. Walmart's done a phenomenal job of making themselves akin to, say, an Amazon with their online presence, whereas Target just hasn't really been able to keep up that way. And their rollout of their Target online's been a little bit haphazard. And that's where we get to your kind of middle to upper income consumer. I mean, on Walmart's last earnings call, they really noted that individuals or households making 100,000 or more are contributing significantly to their bottom line as far as a growth goes. I mean, their online grew 27% over the last year. I mean, that's a huge number for a company that's generating, this last quarter was almost 170 billion in revenue. So that's a pretty significant number. But the thing is, those middle to upper income, especially your kind of middle income individuals, well, they're shifting to that value. They want to see value in what they get. And because Walmart's done a good job of rebranding their stores, kind of cleaning up their inventory, that's led a lot of those middle to upper income individuals to shift to Walmart for their spending, because they're getting more value than they would at other retailers. And whenever they're there, if they're deciding to make a discretionary purchase, hey, maybe you want to buy a game console, or maybe you want to buy, some Apple products or some kind of electronics. Well, they're more often to do that at the place they're already doing their kind of consumer staples, their needs-based spending, versus going somewhere else in order to fulfill that purchase.
So sounds kind of like that traditional example of Target that I was mentioning, where people are going in for the cheaper goods, but leaving with some higher end goods that they feel like they're getting good purchase on, though. I think that's a key point there.
Exactly.
Yeah. Yeah. And something interesting along that line is kind of that dichotomy I was talking about earlier, is that while a lot of these kind of mid-tier, mid-high tier consumers are moving down into things like Walmart for their day-to-day purchases, their groceries, their electronics, they are still staying on the high end for some selective items. We've seen Williams-Sonoma do really well this year, and certain things they don't want to compromise on, your kind of luxuries, your weekend kind of fun stuff, but for their day-to-day stuff really moving down. And that's driven, as we'll see in the higher end consumer too. really a broadening out and kind of a piecemeal of the industry where, like we said, Target's down a whole lot. Those dollar stores are down a whole lot. Walmart rallied off of their last earnings relative to them. And then, like I mentioned before, Williams-Sonoma has done really well this year. And so it's just really piecemeal in the industry right now.
Yeah, I think it's interesting getting into that luxury space too, because you would think inflation isn't going to necessarily harm that upper high income consumer quite as much. But I think this is where it comes to the interest rate piece even more, as you mentioned at the top of the episode, cars, homes, those, if the upper income consumer is buying them, it's typically a cash purchase because the financing is so expensive. These wealthy individuals feel more wealthy when they can get cheap financing because they're not having to move that cash up front, which typically leads to more luxury spending. And so you're getting into an area where a lot of the luxury brands, I'd say the vast majority of them, have really struggled this year just because they're not necessarily financing the purchase of a handbag with debt, but it's because of the things like a car or a house that they may be buying with cash is leaving them feeling like they can't quite splurge on some of these other high-end goods.
Yeah, exactly. You have brands like Dior, Jimmy Choo is owned by one of the big conglomerates, LVMH that owns Louis Vuitton. These companies have seen lots of like slowdown this year, whereas other, similar goods that may be perceived as higher quality or better bargain, like you have Coach has done really well this year. I think they operate in a nice like luxury space, but not ultra luxury where you can't really justify the purchase of a new handbag because it costs $10,000-$15,000. Like some of these other companies where you feel like you're getting that value that you're not seeing everywhere in the market.
Right. And I mean, just to reference our list here, I mean, we've got Dior, LVMH, Kering, Capri, Aston Martin, Hugo Boss, Watches of Switzerland, Burberry, and Porsche are all down 20+%, with many of those being in that down 40+% range just year to date. I mean, that's super significant. And so, I mean, whenever you're talking about trying to pick where the luxury consumer is putting their discretionary dollars, it's really tough. And I'd say that for the most part, we've been out of that space because it has been so difficult. Now you do have a few of those bucking the trend, like you mentioned, Tapestry owning Coach. That's one where consumers have been spending.
They're up 57% this year.
Yeah.
That's big.
Ferrari as well has been one that's been really successful this year. Of course, that's a very unique, very nostalgic brand that has a very loyal following.
But even in contrast to Ferrari, you have Aston Martin, who's in that list of down 20+% this year.
Right. And so you've got a tough luxury environment. And I think that's something that looking forward is going to shift a little bit once we get closer to the end of 2025, once interest rates continue to trickle down. And especially after the stock market rally over the last couple of years, you've got your wealthy individuals probably feeling a little bit more rich here. And so you'll probably see that luxury spending continue to tick back up. But we're being very careful in the luxury space just because it is hard to pick the winners and losers right now.
Yeah. And something that I'm really interested to watch going forwards is specific back to, that kind of pairs trade almost that we were talking about a lot this episode, Walmart and Target, is that with that kind of spending, that kind of day-to-day goods-based spending, like your, necessities, almost your staples, you're talking about very sticky spending. So when people make that switch to start going to Walmart, that becomes their habit. It's very, very habitual space, very much, okay, I need to, stop at the grocery store. I need to stop here, there. Okay, go to Walmart, pick up my produce and, whatever generic stuff they need. And Walmart becomes that list versus Target. And so that's something that I want to watch going forwards because, even if Target kind of cuts their margins or, makes some strategic shifts, or just as the consumer gets relatively wealthier on a real basis, I'm interested to see how much that business really transitions back to Target.
Right. I think a lot of those dollars are going to be pretty sticky and that loyalty is going to be there. Like I said, especially when you're talking about a company that has a fleshed out online presence and now Walmart's rolling out their Walmart membership, that becomes a big piece of it as well. I think we shouldn't neglect to mention kind of the revenge travel trade that's been going on. So many people coming out of COVID are still traveling pretty heavily through 2024, but that's starting to wind down a little bit. So you've seen travel stocks, the cruise lines, the hotels, the travel agency or travel adjacent like booking.com have pretty solid years of the last couple of years that have done better than your typical consumer discretionary stocks. But that's starting to wind down. So as we go forward into 2025, it'll be interesting to see how much of that travel kind of normalizes and shifts to those more discretionary items.
Yeah, no, that's a big trend to watch out for. And, the whole space, there's a lot going on. It's an exciting time. It's, one of these where while we've stayed out of it a lot outside of, certain picks that we have, it's very much a stock pickers environment. In consumer discretionary, people aren't, it's not everything going up all the time. It's very bits and pieces, and really decoding where those dollars are flowing to is going to be a big driver going forward.
Well, that's why we always preach that it's a great time to be in the market, great time to be a stock picker in the market. And I know that you and I really enjoy getting into the weeds as far as it comes to these companies. And I think if you take it a step back, you look at the global macro, the good thing is we've got a strong labor market. We've got wage growth now outpacing inflation. So the consumer sector is probably going to do better on a go forward basis. And that's going to drive the whole industry upwards. But like you said, we're still taking a look at the individual companies and which ones we really think are going to do well on a go forward basis.
Exactly. Thank you, Victor.